Welcome back, everyone. Okay, so I'm going to go back to the beginning of the Generally Accepted Accounting Principles Framework, just to ensure this was covered. This is going to be an overview of the information. Okay, so the Generally Accepted Accounting Principles Framework covers the reporting entity concept, reporting period, cost constraints, materiality, going concern assumption, currency, and recognition and measurement. Okay, so again, I'm going to keep it at relatively high level. So the reporting entity concept is basically what this means is that it's separate from the owner. So as I discussed earlier in the first video, you need to make sure that any information that relates to the business is recorded in the business financials, and anything related to the owners is kept separate from the business. The reporting period. So again, you need to make sure that everything that you record is recorded properly. So whether it's a manual system, whether it's a computerized system, the date that the transaction happens is the date in which it should be recorded. So therefore, you will have accurate financial information, whether it's on a daily basis, a weekly basis, monthly, quarterly, or annual. Cost constraint indicates that the benefits of providing information needs to justify the cost. So this one's a tricky one, but what it means is that you shouldn't spend $1,000 to ensure the accuracy of $10. Materiality information that is significant to decision makers should be included in the financial statements. Going concern assumption is that you should record the information and assume that the business is going to continue. Currency, we're Canadian companies, so all of our information should be reported in Canadian dollars. You shouldn't record something, an invoice, say that you get from a U.S. company. You shouldn't record that as if it's Canadian. It needs to be recorded as U.S. dollars converted to Canadian. So you need to make sure that all the currency is converted to your standard currency, which in our case would be Canadian. Recognition and measurement. So this one here, the one key principle that requires analysis in terms of when a transaction should be recognized is the revenue recognition principle. So depending on when the transaction happens is when the revenue is recorded. So for example, if you sell something to your customer and you sell it to them today, but they don't pay you for a month, you still record the revenue for today, not the day that you receive the cash for it. Okay? That would be recorded as accounts receivable. So you're due to receive that money from your customer in the future, but you have provided them with either the service or the product already. So you must recognize the revenue. Okay. And then any expenses that relate to providing that sale to the customer must be recorded in the same period. So for example, if you sell your customer a pen, then any expenses that relate to that pen must be recorded in the same month. Okay, and that's it for Chapter 1. I know there's a lot of theory there, but again, you're not getting quizzed on it. What it is a SMART book assignment, so it's going to go through the information to ensure that you have the understanding. And so it may take some individuals a little bit longer to go through it. and others may take a little bit of time. Okay, so let me know how you make out and if you have any questions. Thanks, everyone.